Picture a trader in 1921, not a guy with 6 monitors and alerts. A man in a wool suit standing in a cold office, staring at a ticker tape that keeps printing lower. Every minute, the paper says the same thing. Prices are falling, credit is tightening, and the world is suddenly short of buyers. Now smash cut to 2026. Same emotion, new machine. Because this time the ticker tape is digital, global, and instant. It is not just printing, it is transmitting fear at the speed of light. And in hours, the market doesn't correct. It deletes. $7 trillion erased. So today, we are going to do something most people refuse to do when the screen turns red. We are going to compare this moment to 1921. Not because history repeats perfectly, but because it rhymes loudly enough to warn you before the next verse lands. The 1921 setup, when the party ended. After the Great War, the world was exhausted and overstimulated at the same time. Factories had been running hot. Governments had been spending hard, supply chains were stretched, shipping was chaotic, and prices had been climbing. Then the war demand faded, and here's the key. The economy didn't gently slow, it hit a wall. Businesses that had stocked up for a high-demand world suddenly faced a low-demand reality. Warehouses filled, orders vanished, and the only lever left was price. So prices fell. But falling prices are not a simple discount. Deflation is a force. It turns inventories into losses. It turns debt into heavier debt. It turns "I will buy later" into a contagious decision. And once enough people decide to wait, the economy freezes. In 1921, the crash was not a single headline. It was a chain reaction. Demand broke. Prices dropped, profits collapsed, layoffs spread, loans tightened, and the system squeezed itself. The brutal part is that the math of deflation punishes speed. If you sell later, you get less. If you borrow today, you repay in stronger dollars tomorrow. So everyone rushes to protect cash, and the protection becomes the problem. A quick walk through the 1921 mechanism. Think of the post-war economy like a huge parade that suddenly runs out of music. During the war, demand was artificial and constant. Governments ordered, factories delivered. When that demand faded, private buyers were supposed to take over, but private buyers were tired, prices were high, and credit was harder to get. So the handoff failed. Farm prices sagged first, then wholesalers, then manufacturers. Merchants who had borrowed to stock shelves watched the value of that stock drop below the loan. Banks saw that and got cautious. Caution turned into tightening. Tightening turned into a credit drought. That is the 1921 signature. The squeeze was broad, and it was fast for its era. The people living through it described a strange feeling. Work existed, but money did not move. Goods existed, but buyers hesitated. Everyone waited for lower, and waiting is the virus. If you have never experienced real deflation pressure, it is hard to explain. Inflation feels like a storm, noisy, obvious, constant. Deflation feels like a vacuum, quiet, invisible, and suddenly powerful. What the 2026 version looks like on a trading desk. Now translate that vacuum into modern mechanics. In 2026, the system is layered: cash markets, futures, options, ETFs, swaps, and a giant network of funds whose rules are simple. If volatility rises, reduce exposure. If correlation rises, reduce exposure. If drawdowns hit a line, reduce exposure. Those rules are not evil, they are survival math. But when too many players share the same survival math, the outcome is predictable. The first wave of selling increases volatility. That higher volatility forces the second wave of selling. The second wave widens, spreads, and removes bids. That missing liquidity forces the third wave. And that is how you get a move that looks impossible on a long-term chart. You also get something the old world rarely had: feedback from options hedging. When markets fall into certain zones, dealers hedge dynamically. That hedging can become gasoline on the down move. The candle gets longer, not because people hate the asset, but because the structure is pushing it. If you want one phrase for this era, it is rule-based selling. Why deflationary shock can hurt even when prices fall. Here's the confusing part. People hear deflation and think, great, things get cheaper. But markets do not fear cheap prices. They fear the debt that was built assuming higher prices. If your costs fall but your debt stays the same, the debt grows heavier. If your revenue falls, but your payroll stays the same, margins collapse. If asset prices fall, collateral shrinks, and lenders demand more safety. So a deflationary shock is not a sale, it is a tightening spiral. That spiral is why the 1921 story matters to investors today, because the modern economy is not less leveraged, it is more leveraged, and leverage is allergic to falling collateral. The psychology. Why this move felt like a glitch. A 36-hour wipeout triggers a specific mental trap. Your brain looks for continuity. It expects price to move like a human. Step, step, step. But modern price often moves like a machine. Jump, gap, cascade. So you call it manipulation. You call it an attack. You call it a setup. Sometimes there are catalysts, but the bigger truth is simpler and scarier. Speed is the cause. The 1921 recovery rhyme, how a freeze thaws. Now, one more lesson from 1921 that people forget. Hard deflation scares everyone, but it can also clear the blockage. When inventories finally reset, when wages and costs adjust, when credit conditions stop tightening, the economy can rebound with shocking speed. That is not guaranteed, but it is possible. So do not treat the comparison as doom. Treat it as a map of forces. Deflationary pressure can create overshoot. Overshoot can create opportunity, but only for people who are still liquid, still calm, and still thinking. The 2026 shock, same force, higher velocity. Now bring that to 2026. The raw ingredient is similar, a sudden shift in expectations about money, but the delivery system is completely different. In the early 20th century, information moved by paper, radio, and rumor. In 2026, information moves by feeds, algorithms, and automatic orders. So when the market senses tighter money or less liquidity, it doesn't debate, it executes. And that's what makes this 36-hour wipeout feel unreal. It is not only fear, it is structure. Modern markets are built on speed, leverage stacked on leverage, derivatives connected to everything, automated risk models watching the same signals, and funds that must de-risk when volatility spikes. That is the hidden engine, not one villain, not one meeting, a mechanical reflex. When the signal flips, the system sells, because the system is designed to survive. And survival, in a crowded trade, looks like everyone trying to exit through the same door. The deflation playbook, how a panic feeds itself. Let me describe the sequence in plain language. Step 1. The narrative changes. The market goes from growth is fine to growth is fragile, from liquidity is abundant to liquidity is conditional. Step 2. The strong hands stop bidding, not because they hate the asset, because they want to see where the floor is. Step 3. The weak hands get hit first. Stops trigger. Margin calls appear. Positions get forced. Step 4. The selling changes the story. A dip becomes a cascade. A cascade becomes a risk event. A risk event becomes a reason for every model to reduce exposure. Step 5. Correlation goes to 1. Assets that have nothing to do with each other fall together because the problem isn't the asset. It's the balance sheet. That is deflation in motion. It is not just prices falling. It is the shrinking of willingness to hold risk. And that is why the 1921 comparison matters. In both cases, the pain isn't created by a single bad company. It is created by the pricing of money itself. The big difference. 1921 had delay. 2026 has dominoes. In 1921, a factory owner could take days or weeks to realize demand had collapsed. A bank manager could decide slowly. A household could adjust over months. In 2026, the market adjusts in minutes. Risk desks watch the same volatility, algorithms respond to the same thresholds, liquidity providers pull at the same time, and the screen gaps through levels that used to matter. So the question isn't, can this happen? It already did. The real question is, what does it do next? Because after the first wave of selling, markets tend to do one of two things. They either stabilize and rebuild confidence, or they keep tightening until something breaks in the real economy. What 1921 teaches the inventory trap. Here's a lesson from the post-war crash that is surprisingly modern. The moment demand falls, inventories become toxic. In a rising price world, holding inventory feels safe. In a falling price world, inventory feels like a melting ice cube. So businesses cut orders, they delay projects, they slash hiring, they protect cash. That protection spreads. In 1921, it showed up in commodity prices and manufacturing first. Today, it can show up in tech, credit, real estate, or anything tied to borrowing. Because deflation isn't picky, it targets the most levered parts of the system. And in 2026, leverage is everywhere. In corporate balance sheets, in consumer credit, in speculative markets, and in the invisible plumbing of derivatives. So when the market deletes 7 trillion, it is not just a chart, it is a message. It says, risk is being repriced. The digital age problem. Liquidity is an illusion until it's needed. One of the most dangerous myths is that modern markets are more liquid than old markets. They are more liquid when everyone agrees. They are less liquid when everyone panics. Liquidity today is often provided by machines that can step back instantly. In 1921, a dealer could not vanish in a millisecond. In 2026, a quote can. So the market feels deep, right up until the moment you need depth. That is why you get air pockets. That is why you get violent candles. That is why the wipeout happens faster than the human brain can process it. And when your brain can't process it, you do what people always do. You look for a story. You look for a single cause. But the truth is simpler and scarier. Speed is the cause. How to read this move without panicking. Now, I am not here to tell you what to buy or sell. This is education, not a personal plan. I am here to give you a framework. When you see a move this fast, ask 3 questions. Was this a solvency event or a positioning event? If balance sheets are broken, the pain lasts. If positioning was crowded, the bounce can be sharp. Did credit markets confirm the panic? Stocks can overreact, but credit is where reality often shows up first. Did the currency and rate expectations shift together? Because deflationary shocks are usually about the price of money. If those 3 align, the 1921 rhyme gets louder. If they don't, this may be a brutal reset that clears leverage and then stabilizes. Why erased is the wrong word. Let me reframe the headline. 7 trillion wasn't destroyed like a building. It was repriced. Market value is a vote. And in 36 hours, the vote changed. But repricing does have consequences. It changes confidence. It changes hiring. It changes lending. It changes behavior. And behavior is where macro events become real life. In 1921, households and businesses learned to fear falling prices. In 2026, they can learn it again, fast. The 2 paths from here. Path 1. Stabilization. If the system finds a floor, if forced selling ends, if liquidity returns, then the market can rebuild and recover. Sometimes the most violent drops create the conditions for the sharpest rebounds because the weak hands are gone. Path 2. Tightening into slowdown. If credit keeps tightening, if layoffs rise, if spending slows, then deflationary pressure spreads. And the market doesn't just fall, it grinds. The danger is not the first crash. The danger is the second-order effects, the canceled projects, the delayed purchases, the reduced risk-taking. That is how a financial event becomes an economic event. Your playbook. The 1921 mindset in a 2026 world. So what do you do with this comparison? You stop staring at the drama and start watching the plumbing. Here's a simple checklist. Watch liquidity indicators. Are spreads widening or calming? Watch funding stress. Are short-term markets acting normal? Watch volatility. Is it compressing or staying elevated? Watch credit. Is demand for safety rising more each day? Watch real-world signals, shipping, orders, and layoffs. And most importantly, watch your own behavior. Deflationary shocks reward calm. They punish panic. In 1921, people had time to make mistakes. In 2026, the market can force your decision before you finish your coffee. So build the habit now, reduce complexity, know your risk, avoid leverage you don't control, and remember that speed is not intelligence. The 1921 comparison is not a prediction, it is a mirror. It says, when the price of money shifts, the world can snap. And in the digital age, the snap is faster, sharper, and louder. 7 trillion in 36 hours is not normal. It is a warning flare. So if you felt shocked, good. Shock means you are awake. Now stay awake, because the next move will not ask for your permission.